Hello again from Core Wealth. We're going to be having a look at the month of April, what's happened in markets around the world and in South Africa. But before we start, there's been something in the headlines that has got a number of clients a little bit nervous that I'd like to address, and that's the signing of the NHI bill, the National Health Insurance Bill, by President Ramaphosa in South Africa. It's something that we think longer term, there's a lot of thinking and changes that would need to happen for that to be effective. We don't think it's something that the country can afford in its current guise, but that is going to take years for it to firstly be approved. There seems to be, or we're pretty sure there's going to be a lot of challenges, particularly constitutionally, as whether this affects certain people's rights. But then just the question as to whether the government can operate something like this. Currently, they are unable to actually manage the healthcare, the public healthcare of our country in any decent form. And so the question is, well, that's really what needs to be addressed, not whether we take away other forms of successful healthcare in the country. But all we want clients to realize is it's not something to be concerned about right now. Medical aids will still work. There won't be a change of who can go to what facility on the after the elections. This is still something that's going to take a while, so people need not stress about it. So big news is still interest rates. At the beginning of this year, the markets were expecting to see 6 rate cuts in the USA in 2024. That has reduced. In April, it came down to them only expecting to see 1 rate cut. So much more hawkish in the sense of expecting interest rates to stay higher for longer to try and bring inflation down in the US. And this was because you were still seeing companies in April, more than half of the companies on the S&P announced their results. Really good results still coming through from corporate America, and the consumer in America also still looking quite strong and healthy, and that's the key driver in the US economy. So the view that we can keep interest rates higher for longer to try and slow that economy, or slow inflation down rather, and the economy doesn't overheat. The other thing that we saw globally was that emerging markets, China has had a nice pickup after a very slow January and February and a couple of years of really poor returns. That economy seems to be going again, and on the back of that as well, we've seen some of the mineral or resource prices start to pick up, which again is something that's good for a number of the emerging market economies, South Africa included. So in South Africa, the stock market was up very strongly in April, and it was driven by 2 major shares. One being Anglo American. There is a bid now by one of its competitors, BHP, to try and buy its assets and delist it from the Johannesburg Stock Exchange. That saw its share price go up over 30%. And in the meantime, its board, Anglo's board, has rejected that offer, saying that their offer is too low. So that's kept that share price nice and high. The other one is Naspers and Prosus, the South African listed companies that have a big stake in the Chinese gaming company Tencent. Tencent launched one of its most eagerly awaited games early, and on the back of that saw its share price rally quite strongly. The South African facing companies, so companies that have got most of their earnings in South Africa, also were up quite nicely during the month, and this was on the back of people maybe getting used to the noise that we've got around the elections that are coming up on the 29th of May. So if we have a look at how markets internationally performed for the month, on the slide you can see that the month there was a lot of red in the month, so a lot of shares coming off, or companies, markets coming off. So the developed world down 3.7%. Emerging markets were actually up, and that was on the back of the Chinese stock market, and then other emerging markets, South Africa included, doing pretty well. If we have a look at year to date, what's interesting for me is seeing how many of the markets, large markets globally, especially in the developed world, have actually done very well, and have done well. It's been across the board, so it hasn't just been the US, which is the problem that we've seen in the last sort of 5 to 10 years. And so we've seen US equities do well, up some 6% year to date. But then Japanese equities just below 4, European over 5, UK equities almost 5, and even the emerging markets like China now 3% up year to date. And this is something we are expecting to see a bit of a change over the coming years, where there's far more value to be had, we believe, in some of the areas that haven't performed in the past, and America is looking quite expensive, so you have to be quite selective as to what you choose in the American markets. So if we have a look at now the South African markets, the previous slide was in US dollars, this slide is in rands, and we can see that the South African equity market had a really strong month, up 3% in just the month, and that's taken it positive year to date. And we've seen since month end, the market has continued to run quite strongly into May. Listed property down for the month, but interestingly the rand, as I said earlier, strengthening against all other major currencies, so 0.5% up against the US dollar, 1.4 and 1.5 against the pound and the euro respectively. The longer term numbers over the last year, listed property really been the place to have been, and our equity market's quite soft, but we're seeing, we think, quite a turnaround in that as the South African stocks look inexpensive and hold some good potential. So here we have a look at our global strategies and the ones denominated in US dollars first, and we can see that it's green across the board, meaning that our strategies have outperformed the peer group average. I was just looking at how big that outperformance was just recently, and it's been good that they have outperformed, and we're very grateful that we've got those decisions right. And what makes me a little more grateful is the fact that outperformance has been in an environment that, given the way that we think about investments and how much attention we pay to whether something is well diversified, and secondly that it isn't too expensive, these last number of years that these strategies have been running have actually been a period where it's a bit of a headwind for our type of thinking. And so to have come out of this with some outperformance, a nice outperformance, we're particularly grateful for that. But also implying in what I've just said is that I would expect over the coming years, as we see more normal markets, that our strategies could well outperform more than they have in the past. So here are those global strategies that we run in UK sterling or British pounds, and we can see over the longer term since inception also outperforming the peer groups, and some actually quite strong outperformance there. But bear in mind that the since inception number here is only heading towards 3 years at the end of this year. Some slight underperformance over the last year by our most aggressive strategy there, but the absolute returns in pounds are really quite healthy. So looking at the South African models, we can see here that a lot of green on the slide. I'm going to talk a bit about this towards the end of this presentation, but quite happy. Our recurring income strategy is slightly underperforming the peer group, but that is a bit of an anomaly in that the peer group is actually quite different to those strategies because they are generating recurring income. But on the whole, very happy with the outperformance over both the short and the longer term. Compound interest has often been referred to as the eighth wonder of the world, and that's really just getting growth on growth on growth. And here what we've done on the graph on the left hand side, we've shown you the difference in outcomes. If we took R1 million at the beginning of 40 years, which is typically the amount of time that most people will be working for, and we just grew that by the orange line 10%, the dark green line is just 1/4% more, and each line is 1/4% more. And you can see the difference in return over that long period of time. What we've done on the graph on the right hand side is just to say, well, what does that additional return equate to? But we've shown it in today's money. So what we call the real benefit, or we've adjusted for inflation. And simply put here, if you can generate an additional 1% of return over the life of your investment, 40 years in this case, you can end up with an additional 1.9 million rand after the 40-year period. In South African terms, that essentially is an additional middle class home that you could buy with the extra return that you'd get. Another key investment principle is to remain invested, and we're going to have a look at that. And the graph on the left here just shows the Johannesburg Stock Exchange, and it shows each month's return since 1995, so almost 30 years ago. And what we've done is we've just ordered it from best month to worst month. And you can see that the best months were getting close to 15% just in one month, and the worst month was actually getting close to losing 30% in one single month. What we've done on the graph on the right hand side is we've said, well, if you invested for that whole period, you didn't miss any of the months, you invested for every single month, you would have ended up, your 1 million would have grown to 6.5 million. And we've again shown this in today's money, as we explained in the previous section. However, if you just missed the 3 best months, the line in green shows what you end up with. And just missing 3 months, the 3 best months, you lose 2.1 million rand in your eventual outcome. If you miss the best 5 months or the best 10 months, you can see the impact. So missing just 10 months out of a 30-year period, you are reducing your outcome from 6.5 million to 2 million. The point being here is that you don't know when the best month is going to occur. Now, following on from that concept of remaining investing, here's another way of looking at it. We've just shown on this graph, and this time we've shown the market in actual chronological order. The blue shaded parts show when the market went down, and you can see that over that almost 30-year period, the market actually went down quite a lot. But the interesting point is we've just shown the top 5 best months. So the blue lines are just the negative returns, and then we've just overlaid that with the orange lines where the best months actually returned. And what you can see from this is that almost all of those best months occurred in the middle of really tough periods. And this just goes back again to emphasize the point that things often get hairy in markets, things get scary and you're not sure what to do. But often by pulling out, you not only miss some of those drawdowns, but you also miss some of the best months that come around in investment markets. As you're aware, we have a range of South African model portfolios as well as 2 ranges for global investors, one in US dollars and one in British sterling. And this slide just has a look at what those returns on average have delivered since they started. Now, they don't all have the same starting period. Some of our South African models have almost a 12-year track record. Some have only got a 10-year track record. Our US dollar strategy is heading towards, it's in its 8th year at the moment. And our UK sterling strategies are in their 3rd year at the moment. But what we're trying to illustrate with this graph is just saying, well, how have all of our models done relative to their peer groups? And the gray line, or the gray portion of the bar, is the peer group, and you can see, for example, on Global Defensive that the peer group over this period actually gave investors a negative return, while the purple portion is the additional return that has come from the decisions that we at Core Wealth have made. And through time, we obviously want that purple line to be as broad as possible, and we're getting it more right in some of the strategies than others. But important for us is to see that this outperformance is consistent across the range, in that we have outperformed the peer groups across the range and over long periods of time. And that's really an important thing for investors to be aware of, that their manager and advisor is able to add to their investment returns over the long term. Thanks for taking the time to watch this. If you've got any other questions around markets or around the medical aid things, please don't hesitate to be in touch with us. We'd love to just chat through, and we don't want people fretting about things that they don't need to. From our side, thanks again, and we look forward to seeing you in future. you.